Contract manufacturers that think of themselves as producers of goods may have to start thinking of themselves as service providers, at least under the new revenue recognition standard, which was issued by the FASB and ISB at the end of May of 2014. This podcast will provide you with a high-level summary of the new revenue standard and some of the impacts that the standard may have on contract manufacturers. My name is Brian Schild, and with me today is Lauren Thomas. We're both on the Revenue Project team in KPMG's Department of Professional Practice. So Lauren, can you start by giving us an overview of the standard?
Sure, Brian. The core principle of the new revenue standard is that an entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. The standard establishes a 5-step model for implementing the core principle. Step 1 is to identify the contract with a customer. Step 2 is to identify the performance obligations in the contract. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to performance obligations. And finally, Step 5 is to recognize revenue when or as an entity satisfies a performance obligation. Let's move on to talk about some of the potential impacts to contract manufacturers. The first item I would like to highlight is the timing of revenue recognition. Currently, contract manufacturers generally recognize revenue at a point in time when manufactured goods are shipped or delivered to a customer. Under the new standard, contract manufacturers may be viewed as performing a service that is satisfied over time as the manufacturing occurs.
So, Lauren, would this actually lead to a change in the pattern of revenue recognition?
Yes, it could result in recognizing revenue before the goods are shipped or delivered, which leads me into the next item I would like to discuss today, which is measuring progress. Contract manufacturers that account for these arrangements as an overtime performance obligation will need to determine the best method for measuring progress during the manufacturing process. The method selected should depict the manufacturer's performance in transferring the goods and services to a customer. Contract manufacturers should consider both input and output methods.
So, in cases where there's significant WIP, is there a preferred method, be it the output or the input method?
That's a good question, Brian. The boards concluded that the output methods, such as units delivery, do not appropriately measure progress when WIP is significant. Therefore, many contract manufacturers will need to use input methods, such as cost to measure progress. The final impact I would like to highlight today is potential changes to systems and processes. Entities may need to modify systems and processes to recognize revenue based on cost incurred compared to total estimated cost, or another measure of progress. Entities that continue to use their existing systems to calculate revenue on a ship and bill basis may be required to manually adjust revenue and costs at each reporting period. Entities also may need to consider if two systems may be required for contract manufacturers that produce their own goods and sell goods through other distribution channels. Now let's change gears and talk about the effective date. The effective date of the new standard for public business entities and certain not-for-profit entities will be for periods beginning after December 15, 2016, which is January 1, 2017 for a calendar year-end company. Under U.S. GAAP, early adoption is not permitted. All other entities will have a 1-year deferral for annual periods to 2018 for calendar year-end companies and a 2-year deferral for interim periods. Although these entities are permitted to adopt in 2017 at the public business entity effective date.
How about disclosures? Can you touch briefly on those?
Sure. Disclosures are going to expand significantly. There's quantitative disclosures that will be required quarterly, and these include disaggregation of revenue, information about contract balances, contract costs, and the transaction price allocated to remaining performance obligations. There's also several qualitative disclosures. As companies think about their systems, processes, and controls, they should also be thinking about the data necessary to meet the disclosure requirements. Finally, today we're going to talk about the transition approaches. Entities can select from 3 different transition approaches. The first approach is full retrospective. Under this approach, an entity would recast all contracts for all prior periods presented. The second approach is retrospective using one or more practical expedients. An example of a practical expedient is entities would not have to recast contracts that began and ended within the same annual period. The third transition approach is cumulative effect at date of adoption approach. Under this approach, an entity would record a cumulative effect adjustment at the beginning of the year of adoption. In addition, an entity would be required to account for the revenue transactions both under the new standard and legacy GAAP in the year of adoption to determine the effect of the accounting change. They would also be required to provide disclosures in the period of adoption of the impact of the change on each financial statement line item.
Thanks, Lauren, and thanks to you, the listener. For additional information, refer to KPMG's Financial Reporting Network website, including the latest on the revenue recognition page, which links to KPMG analysis of the new standard, defining issues, webcasts, and other podcasts.